of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 3 Financial Decisions, Unit 9 Sources of Finance, Part 1. After completing this unit, you should be able to appreciate the importance of different sources of finance, understand classification of sources of finance under various categories, discuss the advantages and disadvantages of different sources of finance, and explain the ways in which funds can be raised for the smooth and effective functioning of an enterprise. Introduction. Financial market, as discussed in the previous unit, is a system of processes and functions that are usually regulated by rules and guidelines for enabling participants to transact in financial products and instruments. Traditionally, transactions used to take place only in unorganized marketplaces. These unorganized marketplaces were not subjected to specific rule or regulation. When countries developed and as economies evolved, the need to regulate markets to remove distortions and to facilitate free flow of funds gave rise to regulatory bodies. The concept of organized markets evolved to entrust confidence among market participants. The traditional organized financial markets in India are: number 1, money markets for maturity of less than or equal to 1 year, and number 2, capital markets for maturity of more than 1 year. The capital markets comprises of equity markets and debt market. The capital markets comprise of the equity markets and debt market. New equity stock offering is issued in the primary market. The corporates issue new equity stock for raising capital towards expansion of business activities. The stocks that are issued are subsequently listed on the Indian equity exchanges, that is NSE, BSE and other regional exchanges, which comprise the secondary markets. The components of the Indian financial markets include not only the capital markets and money markets, but also the foreign exchange markets, insurance, pension fund markets, loan markets, and savings and investment markets. The funds are required basically for two reasons: one, to acquire fixed assets, and the other, to run the operations of the business. It is imperative for any organization to raise funds for the smooth and effective functioning of the business. Arranging for the required funds for each department of the business is highly complex, which requires several decisions to be made. Business usually needs two kinds of finances, the short term and the long term. There are several factors which will be affecting the requirement of fund for a business. The quantum of finance needed may depend on several factors such as the nature of business, scale of operations, business cycle, assets structure, etc. There are different sources for raising capital for different purposes. In the previous unit, we have discussed as to how different financial institutions and markets facilitate the organizations in raising funds from the market. Here, we will be discussing some of these instruments or sources that these markets and institutions provide us to finance the business. Classification of sources of finance. The sources of finance are classified based on period as long, medium, and short-term finance. As per the ownership and control, it is classified as owned funds and borrowed funds. Depending upon the source of generating this fund, it is either internal or external. Long-term sources. The long-term finance is raised when the need for funds is for more than 5 to 10 years. Long-term finance is required for acquisition of fixed assets having a life of more than 1 year or investments which have long-term impact on the earnings of the company. For instance, if a firm wants to buy a patent or brand which in turn contributes to the sales of the firm for a long term, it requires long-term funds for such acquisition. Some of the long-term sources are equity, debt, asset securitization, venture capital, etc. A company can raise funds through capital market by issuing financial securities such as shares and debentures. A financial security is a legal document that represents a claim on the issuer. The corporate securities are broadly classified into ownership securities and creditorship securities. There are also securities known as hybrid securities having the mix of the features of ownership securities as well as creditorship securities. Depending upon the market conditions and financing strategies, the issuers adopt different methods. Equity capital. Equity share capital is one of the most important sources of raising capital. Equity capital represents the owner's equity, which is a prerequisite to start a company. Its holders are residual owners who have unrestricted claim on income and assets and who enjoy all the voting power in the company and thus can control the affairs of the company. It is a prerequisite to the creation of a company. From the corporate perspective, there is no fixed obligation of funds to be paid to the equity shareholders. It is perpetual in nature. If the shareholders require funds, they can sell the shares in the secondary markets. In exceptional cases, a company may buy back the shares. A company may buy back its shares without shareholders' resolution to the extent of 10% of its paid up equity capital and reserves. However, if a company intends to buy back its shares to the extent of 25% of its paid up capital and reserves, then the same must be approved by shareholders' resolution. Section 68, 69 and 70 of the Companies Act 2013 along with the Rule 17 of the Companies Share Capital and Debentures Amendment Rules 2016 regulate the process of share buyback for unlisted companies. The buyback of shares listed on recognized stock exchanges is regulated by SEBI regulation. Equity share capital is also known as risk capital as the equity shareholders are exposed to greater amounts of risk, but at the same time, they have greater opportunities for getting higher returns. The obligations of companies towards their shareholders are to distribute the income left after paying the claims of all other investors, for example, debt among the equity shareholders. The equity shares also give shareholders a residual claim on the assets of the company in case of liquidation. Now let's discuss the advantages and disadvantages of equity shares. Advantages. Number 1. The equity shares are not repayable to the shareholders and thus it is a permanent capital for the company unless the company opts to return it through buying its own shares. Number 2. The debt capacity of a company depends on its equity, including reserves. Hence, raising of capital through equity enhances the company's debt capacity. Number 3. The company has no legal obligation to service the equity by paying a certain rate of dividend, unlike the debt for which interest is payable. Therefore, the firm can conserve the cash when it faces the shortages and pay when its earnings are adequate to do so. Disadvantages. Number 1. Among the alternative sources of capital, the equity capital cost is high because of higher risk, flotation costs, non-deductibility of dividend for tax purposes, etc. Number 2. Investors perceive the equity shares as highly risky due to residual claim on assets, uncertainty of dividend and capital gains. Therefore, the company should offer higher returns to attract equity capital. Number 3. Addition to equity capital may not raise profits immediately but will dilute the earnings per share, adversely affecting the value of the company. And number 4. In raising of capital by offering equity shares will reduce the power of promoters' control unless they contribute proportionately or opt for non-voting shares which are costlier than ordinary equity shares. Preference shares. The preference shares are called quasi-equity, having characteristic of both equity and debt. These shareholders get dividend which is fixed and paid before anything is paid to equity holders, but they do not have voting rights. In case a company fails to pay the stated dividends, they may acquire the voting rights in certain circumstances. The investors can claim stake over the residual assets at the time of liquidation of the company, before the equity holders and after the debt holders. They behave like debt instruments because they carry fixed dividend rates. They behave like equity instruments because they offer the dividend to the shareholders without any obligation on the company in case of liquidation. The advantages and disadvantages of preference share capital can be discussed now. Advantages. Number 1. The dividend rate is fixed, providing a constant rate of income to the investors. They do not present a major control or ownership problem if the dividend amount is being paid to them. In certain specific cases, preference shareholders have voting rights, but they do not pose any major control problem for the promoters. Number 2. The other advantage of preference shares is that of cumulative dividends. Cumulative preference shares carry accumulated unpaid dividends year to year till the company can pay all the dividends including the arrears at a stated rate. Number 3. It helps to maintain the status quo in the control of the equity stock and reduce the cost of capital, as the preferred stock carries lower rate of dividends as compared to other debt securities like debentures, which usually carry higher rates of interest. Number 4. The preference shareholders may have a right to share the surplus profits by way of additional dividend and the right to share in the surplus assets in the event of winding up after all kinds of capital have been repaid. And number 5, the company does not face liquidation or any other legal proceedings if it fails to pay preference dividends, as there is no such legal compulsion to pay preference dividends. Disadvantages. Number 1. The preference shareholders do not have voting rights, so there is no direct control over the management of the company. Number 2. They get only a fixed rate of dividend even if the company enjoys more profits. Number 3. The cumulative preference shares become a permanent burden so far as the payment of dividend is concerned. The company is under an obligation to pay the dividends for the unprofitable periods also. Number 4. In case, if the company earns returns less than the cost of preference share capital, it may result in decrease in earnings per share, that is EPS, for the equity shareholders. And number 5, for tax calculation, dividend on preference shares is not a deductible expense, but interest is a deductible expense. Debentures. Debentures are one of the principal sources of funds to meet long-term financial needs of companies. Though there is no specific definition of debenture, according to the Companies Act 1956, the word debenture include debenture stock, bonds, and any other securities of a company. Thus, the debenture is widely understood as a document issued by a company as an evidence of debt to the holder, usually arising out of loan and mostly secured by charge. The debentures are instruments for raising debt finance, and the debenture holders are the creditors of the company. Debt provides the capital to a company with fixed cost liability, that is, interest to be paid annually or semi-annually. The debenture holders get interest paid as the payment of interest is an obligation on the company, but they do not have voting rights which equity shareholders have. They have claim over the assets of the company before the equity holders. The obligations of the company issuing debentures include establishing a trustee through a trust deed. The trustee, usually a bank or financial institution, is supposed to ensure that the company fulfills its contractual obligations. Secondly, debentures are backed by mortgages or charges on the immovable properties of the companies. These debentures are redeemable in nature with maturity of more than 18 months, for which the company must create a debenture redemption reserve. Now let's discuss the advantages and disadvantages of debentures. Advantages. Number 1. It is one of the long-term sources of finance having a maturity period longer than the other sources of finance. Number 2. The debenture holders are only creditors of the company and hence they cannot interfere with the company affairs as they do not have voting rights. Number 3. Further, the debenture holders are entitled to interest at a fixed rate which is usually lower than other sources of long-term finance. Number 4. The cost of debentures is usually low as the interest payments on debentures are tax-deductible expenses. Thus, it helps to reduce the tax burden of the company. And number 5, in case of liquidation of the company, the debenture holders have priority over equity shareholders in the distribution of available funds of the company. Disadvantages. Number 1. The interest on debentures is payable even if the company is unable to earn profit and hence it may not be suitable to those companies whose earnings fluctuate considerably. Number 2. Secured debentures restrict the company from raising further finance through debentures as the assets are already mortgaged to the debenture holders. And number 3. The debenture holders can initiate the legal proceedings against the company if it defaults on its interest payment or principal when they become due. Retained earnings. The companies can raise funds from internal sources through the retained earnings which are plowing back of profits for future expansion or diversification activities. Let's discuss its advantages and disadvantages. Advantages. Number 1. This is the lowest cost of fund and does not involve any flotation cost as required for raising funds while issuing different types of securities. Number 2. If the company uses retained earnings, it is not under any obligation for payment of dividend or interest on retained earnings. Number 3. As there is no implicit cost of retained earnings, the value of share will increase. And number 4. These funds being internally generated, there is a greater degree of operational freedom and flexibility. Disadvantages. Number 1. Excessive use of retained earnings may lead to monopolistic attitude of the company. Number 2. If retained earnings are used more, it may lead to overcapitalization, which is symbolic for inefficient working of an organization. Number 3. By manipulating the value of shares in the stock market, the management can misuse the retained earnings. And number 4, this source of funds is uncertain as the profits of the business are not certain. Venture capital. Venture capital is usually in the form of equity or quasi-equity instruments in a new company set up to commercialize a novel idea. It is investment at the early stage in case of high growth projects which have high risk with the potential high returns over a period ranging from 3 to 7 years. The risk factor being high, the probability of failure is also high. The venture capital investment is hands-on investment where the investor mentors and advises the promoters of the business in which the investment has been made. The venture capitalist is an investor who guides the project through its different stages of growth by identifying avoidable pitfalls and directs the business along with the possible avenues of growth. The returns to the venture capitalist are from the handful of the projects which succeed. The venture capitalist is a partner who brings more money to the project. Many projects which find it difficult to raise funds from banks and other financial institutions approach venture capitalists for assistance. The venture capitalists conduct a preliminary project appraisal which includes verification of whether it is in their interest of the business. Further, venture capital organization provides value addition in the form of management advice and contribution of overall strategy. The relatively high risk will normally be compensated by the possibility of high return in the form of capital gains in the medium term. The main features that distinguish venture capital from other sources of capital market are: Number 1. Venture capital is a form of equity capital for relatively new companies which find it too premature to approach the capital market to raise funds. However, the basic objective of a venture capital fund is to earn capital gain, which usually will be higher than interest at the time of exit. Number 2. The transfer of existing shares from other shareholders cannot be considered as venture capital investment. The funding should be for new project or for rapid growth of the business with cash transferring from the fund to the company. And number 3, all the projects financed by the venture capitalists will not be successful. However, some of the ventures yield very high return to more than compensate for the losses on others. Thus, the venture capital firms fund both early and later stage financing requirements of a firm, balancing between risk and profitability. This is an ideal source of capital for promoters having very good technical and management skills with limited financial resources. Leasing. Leasing provides an alternate method of financing the business to acquire assets. Instead of borrowing for acquiring assets, it is possible for firms to acquire the assets on lease. A lease is a contract whereby the owner of an asset, the lessor, grants to another person, the lessee, exclusive rights to use the asset for an agreed period in return for the payment of a rent called lease rental. The capital assets like land, buildings, equipment, machinery, vehicles are the usual assets which are generally acquired on lease basis. The lessor remains the owner of the asset, but the possession and economic use of the asset is vested in the lessee. The advantages and disadvantages of using leasing as a source of finance can be discussed now. Advantages. There are several benefits derived by the lessee by acquiring the assets on lease basis as compared to buying the same, and they are: Number 1. If the capital asset is needed for a short period, say a year or two, leasing is a very convenient and appropriate method of acquiring. It dispenses with the formalities and expenses incurred in purchasing the asset and selling it soon after the need is over. Number 2. In case of owning an asset, the firm bears the risk of the asset becoming obsolete. In the present age of technological innovations, risk in owning an asset with outdated and old technology cannot be ignored. Leasing provides a shield against all these hazards by shifting the risk of obsolescence of equipment to the lessor. Number 3. Under operating or full service lease, the lessee avails of the maintenance and other services provided by the lessor, who is well equipped, qualified, and experienced to provide such services efficiently. Of course, the lessee pays for such services in the form of higher rentals. Number 4. Many leasing companies specialize in leasing a few types of equipments, machines, or vehicles only. They can easily bargain with the suppliers or manufacturers, etc., and acquire the assets at better prices and can economize in other administrative expenses also. The lessee may get a concession in lease rent based on the economies derived by the lessor. Number 5. When an asset is acquired on the lease basis, lease rentals are shown as an expense in the firm's profit and loss account. Neither the leased asset nor the liability under the lease agreement is shown in the balance sheet. Hence, the debt-equity ratio remains unaffected as compared to a firm which buys the asset with borrowed funds. Disadvantages. Number 1. The lessee undertakes to pay to lessor regularly lease rental as consideration for the use of the goods. So the cost of this is higher as compared to other sources. Number 2. The goods must be returned to the lessor exactly in the same form after the lease period is over. The lessee cannot make any considerable changes to the asset or property as he is not the owner. Number 3. The lessor, after handing over possession of the leased asset, remains owner of the asset throughout the lease period and even thereafter. And number 4. After the lease period is over, the lessee will not get the ownership over the leased asset, though quite a good amount is paid over the years in the form of lease rentals to the lessor. Hire purchase. Hire purchase is another method of acquiring a capital asset for use without paying its price immediately. Under hire purchase arrangement, goods are let on hire. The hirer or user is allowed to pay the purchase price in installments and enjoys an option to purchase the goods after all the installments have been paid. Thus, the ownership in the asset is passed on to the hirer on payment of the last installment. The amount and number of installments is fixed at the time of delivering the asset to the hirer. If the hirer makes default in making payment of any installment, the seller is entitled to recover the asset from the hirer. The hirer may on his own also return the asset to the hiree without any commitment to pay the remaining installments. Thus, the property in the asset remains vested in the seller or hiree till the right of purchase is exercised by the hirer after making payment of all the installments. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.